You have a duplex, one person moves out, you lost 50%. Now, you have a $800,000 storage facility and you could have 70 doors. So you can literally lose 10% of the occupancy and you're still cash flowing. These are metal boxes. These are garage doors.
Yeah.
Like, people are paying down your debt by putting stuff on the floor. Every month they pay you. Every year they pay more. And over the long run, you're making hundreds of thousands of dollars on that spread. And so it's just boring and it just click, 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 works.
Yeah.
What's up, everybody? Welcome to Self-Storage Income, and today we're talking about why self-storage. There are a lot of different investment opportunities, especially right now. And there's a few things like cash flow that are just a given when you're looking at an investment like storage, but that's not all of it. So why storage? Why now? What are the benefits? And what does that investment look like? So if I invest in it, what are the pros and cons compared to other assets and the long-term benefits? So it's not as simple as just cash flow. There's a lot of other things going on that are very, very large as far as an investment goes to your overall returns, wealth creation strategy, especially when we compare it to other options right now that are also good options. It's just different. And a lot of times we don't really notice what that is. But before we dive into that real quick, guys, our event's coming up, so make sure you're there. All things self-storage, self-storage income, Bend, Oregon. Well, outside of Bend. It's at a resort outside of Bend.
And the resort's amazing. If you guys have got to be there. It is the most premier event in self-storage. We've got guests that are coming out this year who are self-storage experts who've been in the game for decades. In the past, we've had some people coming in from various different industries. This year, 100% focused, self-storage only. Yes. If you want to learn everything top to bottom, storage-wise, this is the place to be. September 16th through the 19th. Be there, get your tickets, get your spots saved, come hang out with us. And again, it's not like an event. It's like a very intimate setting.
Very intimate. We don't accept everybody. We're capping out. Actually, we got too big for the last resort, but that was only like 300 people. Yep. So we keep this. We're not trying to get thousands. This isn't a big sponsorship thing like sell from stage. No, that's not what we're doing. This is like a large mastermind. You're there with us, me and Connor, with everybody else. A lot of people, obviously, from our community will be there, but it's meant to be networking and learning with people that are doing and 100% self-storage. We have activities, food. This is high end, and it's cheaper than going to even like the National Associations. So this is really awesome.
I mean, even something that's similar, like I heard somebody that was like last year, they were like, man, I've never been to an event, like a storage event, that's serving people steaks and all these things. And we're just like, yeah, dude, this is what we do.
This is what we do.
Freaking amazing.
Yep.
So
fireworks shows, this is literally all the way. We love it. It's our time. So
good stuff.
16th through the 19th. Follow the link, everybody. Okay.
With that said,
let's get on to this. Connor, you were really talking about this. You wanted to drive this topic home. Tell me real quick though, why were you thinking about this topic? What was driving this point? Why were you'd been thinking about this for a while and this had to do with your communication. So what's driving it?
Yeah, so we've seen a lot of questions, whether it's in our online community or the one-on-one coaching that I've done with some of our clients and some of those things that are getting into storage. And the question is always, hey, why? Like, if I'm looking at all these other investment options. I've got the IRAs and the 401ks, and I've got the index funds, and I've got all these different options, the more quote unquote traditional options, right? Or CDs, interest rates are high and CDs are, they've got somewhat of a return,
And even other real estate, multifamily, or, all this stuff.
Exactly. So there's all these different bits and pieces from a traditional part to, other real estate asset classes. And I really wanted to dedicate this episode to diving into identifying what separates storage from these other asset classes. And a part of that, too, is I wanted to touch on why self-storage is a great first investment, because I feel like there's a lot of people out there that, they're looking at real estate, they're looking at buying businesses, and they look at it and they say, well, storage is like this thing. I'm going to have to wait for that. I'm going to go do my single family home or duplex thing or whatever. And, and I know we've talked about this before, but I really want everybody to hear it, to understand it, to look and say, hey, I could go and find a storage facility for roughly the same cost basis going in. But instead of buying a duplex where, one person moves out and suddenly I'm at 50% occupancy, I can have a storage facility that not only cash flows more, but has more tenant diversification, that has some better hedges, some of those different pieces there. So I wanted to touch on those different aspects and wanted to compare and contrast, especially that piece of why self-storage is such an amazing thing to invest in as compared to those traditional options. Because I hear it all the time, like, oh man, if I'm going to buy this small facility, and my return just across the board is going to be, 5%, let's say. Why don't I just go and put that money into
like first year cash flow, 5%? Yeah. Why don't I put that into a CD and maybe get that 5%?
Exactly right. So I want to dive into that. But first, man, why do you think storage is a great first investment?
So storage, look, when we're looking at commercial real estate, that seems very overwhelming. First and foremost, I think people look at that and I know I did, right? You're going, holy cow. But the price level for storage, there's way more lower barriers of entry. The price point alone, you've mentioned in most markets, if you're in a first, second tier market, pretty much all rental properties, duplexes are going to cost you the price that is over or at what you can buy storage facilities across the United States for. Now, when we're looking at price, storage facilities go from $200,000 even, all the way up to 15, 20 million, right? Or more in some cases. But if you took it, so when you look at that spread, a lot of people don't understand that market, that lower market, sub $2 million, that is a huge market. That is a big amount of the total inventory on the market that covers in cities all over, right? All across the United States. And the sub-market is not played by institutional capital. They don't go down there. Like institutional capital is not going to go buy a $600,000 storage facility, right? Firms aren't. We're not, right? Like we're not going to do it. Why? Because well, first of all, that makes the returns really good. You're dealing with mom and pop investors, has higher cap rates. They're generally not as efficient. And so that means you can do very basic things to increase the yield or net cash flow. So great value add opportunities. And there's a lot of them to choose from. You get the diversification, like you mentioned, doors. You get the tax benefits. But now when we usually say this, they go, well, if you get such a great return, why aren't you buying it? That's always the first question I get, because you can get a better return on your cash on a $600,000 storage facility than I can going out and buying an $8 million one. Now, if people say, if that's true, why wouldn't you do it? It's really not that complicated, actually. I need to deploy, let's say by the end of this year, we're trying to deploy $30, $40 million. If I was putting $200,000 down,
how many?
On an asset, I mean, we couldn't even do it profitably because the volume of them alone that we would have to buy, I could not deploy that capital by the end of the year. Well, then so it doesn't make sense.
Yeah. I mean, the other piece to that too is even though the percentage return might be smaller, that pie is larger.
Yeah.
Even though the percentage is smaller, if that's making sense. You're getting the piece of the watermelon versus piece of the grape scenario.
So upside over time and everything, you get a lot more. And you get more depreciation for it. There's other things that make that obviously really good. But the biggest thing that makes the returns different is the buy. There's just not, you're not going to go find $10 million storage facilities that are ran like you are a $500,000 or $1 million one for sure. Mom and pops that they're, because those are owned by people that are more professional. They have professional management. They can hire professional management because you can do third parties that are really high level. So there's this whole another reason why they don't go down there. So
well, this is another
not
thing.
Economically available for us. Like literally, that's the reason.
Yeah.
It's not the return. No, because we started there. That's where we started. So we actually built starting there, and then we moved from there to bigger ones, and then we moved to bigger ones from there. So it's not like we would never do them. We did. We just can't deploy that capital and manage. We would the people we have to hire, the logistics, it doesn't work.
Yeah. Well, and the other thing that you're hinting to is how storage is valued versus other asset classes. Again, if we're talking duplexes, we're talking these other, just single family residential homes, those things are valued based on comps.
Yes.
Versus cash flow and how you would value a business, which is another huge advantage.
Self-storage is an investment.
Yes. Because it's not being like, hey, this is what the comp is.
No.
And you're not going to make any money, but you're still going to pay top dollar.
Yeah.
No, that's not the scenario.
No, you are going to value it based upon net income. And even if the owner doesn't value it, all banks will and all third parties will. So if you went to buy it and the owner wants you to pay, an amount that makes it not cash flow, well, the bank's not going to loan you the money. So you won't be able to buy it. And when you go down market, especially, they're way more sensitive to this, meaning that if you're buying a $600,000 or $700,000 storage facility, the banks that are lending on those and using those, they're sensitive to interest rates. That means that those sellers' options, the people they're selling to and have to sell to, those buyers, right, are subject to local banks, high interest rates. That means you can get much better prices. When you move into the bigger assets, you have institutional money that gets cheaper money. So you have to spend a lot more. Makes sense. That is a huge benefit. Huge benefit. If you're going into a marketplace and you have to compete with internationals, right, that's rough. So if I'm starting out, the comp thing alone, for traditional people, if you went and bought a house, Tom wants to live there, so he'll pay $400,000. And you're like, yeah, but if I bought it as a rental property, right, and I would never make money, I could never get that thing to cash flow because of that price. Nobody cares about that. It's like, yeah, but Tom wants to buy it. Nobody buys storage facilities because they like the grass on the side of the facility where their kids can
got
play.
A good view.
Right, yeah, exactly. That's not what's happening here. Yeah. So it is purely an investment, which makes it a great place to start because you have third parties that you can work with, that you have to work with. Banks, title companies, right? Everybody's looking at that value, making sure this is going to cash flow, and they're all working together because that's all it is an investment. Yet in so many cases, it's cheaper than that house or that duplex.
Right.
And the other biggest thing is something you mentioned, because it is a investment. There's a few things that drive it. Doors. You have a diversification of revenue.
All right, everybody, quick interruption. I wanted to let you guys know about our live event, SSI Live, going on this September the 16th through the 19th. It's going to be in the beautiful location just south of Bend, Oregon at the Sun River Resort. It's an absolutely phenomenal venue for this occasion. This is the premier self-storage event of the year. You're going to be able to be there live with me, with AJ, in a small, intimate environment, and it allows you to network with some of the best minds in the self-storage industry, from operations to remote operations to closing a facility to lending to structuring deals, everything in between. You're going to be able to get a start to finish understanding of exactly how to find deals, how to put them together, how to start owning and operating a self-storage asset from start to finish. You're also going to be able to hear from individuals who have been a part of our SSI community and membership, where they started with just one facility and being able to leverage what they know to do all these amazing things for them, their families, their futures by doing exactly what you're doing, listening to the podcast, coming to these events, being a part of this community. They even have some incredible incredible activities that we can participate in while we're there. It's going to be anything from volcanic hiking to floating to horseback riding. There's all kinds of amazing opportunities to get outside of just the sessions, connect with other individuals at the event, because that's what it's all about. Bringing people together, building those relationships, being able to put deals together to fund them. So take a minute, click the link in the show notes below, go register, get your spot secured, and then of course, come back to the podcast.
You have a duplex, one person moves out, you lost 50%, right? Now you have a $800,000 storage facility and you could have 70 doors.
Mm-hmm.
So you can literally lose 10% of the occupancy and you're still cash flowing, right? That is like a big difference. You can move people in. There's things that you can do to affect that income that you cannot do in a marketplace where if you just went, oh, well, my duplex, I'm going to raise prices, right, that are way higher than this duplex over here. The market doesn't accept that. You just can't go increase rent. Right, on somebody. You don't have people living in it. That means you don't have toilets. You don't have to worry about evictions like you do in more what I'd say for real estate. If you're beginning, most people look towards simply shelter. So that is viewed as the beginning investment, which for me, I'm like, that's like, as a beginner investor, why do you want to be in charge of buying something that families are living in, the liability associated with it, the cost? If you have one thing break in that house, you have a water heater, right? And then two, like, you got to evict those people. You've got to, there's so many laws associated with it.
Dude, those dynamics alone from like an eviction standpoint and managing tenants, that's a phenomenal point that I don't think we've hit on a lot in the past is, I mean, yeah, that handling of a tenant who's living in a home versus somebody who's choosing to just rent this storage facility because they have extra stuff.
Put their junk, down on the ground.
Whatever. Like, that's a totally different dynamic.
It's not their residence. They don't have laws like they do where you're living. No, it's literally a slab. And you're allowing someone to put stuff on that slab. And you have a contract with them that says, hey, listen, if you pay me this much money a month, I'll let you put that stuff on that slab. But this is my slab.
Right.
You don't live here. You don't get anything like that. And if you don't pay me, I'm throwing your stuff off my slab.
Yeah. Well, even the urgency and the management and the logistics of it, storage is definitely easier in a lot of ways or more simplified in the fact that, if somebody's in a home and they're waking up at 3 a.m. because there's a pipe that burst or there's this or that going on, like, you've got to be on it. Like, it has to be there right then, right there.
You have safety issues.
Dude, there's so much to it. Whereas storage, you want to obviously be on it if you have issues going on, but it's not like this, you've got people living in this space kind of thing.
Exactly.
Right.
But with the same token,
or you shouldn't have them.
You shouldn't have it. With the same token, looking at other types of investments that beginner investors might invest in. You go, okay, well, I have stocks. So then you go into the public markets. And really, when I look at investors and starting out, when you're looking at an investment, this is one of the biggest defining differences, a direct investment versus public markets. And so when we're looking at these two sides, I think beginner investors, right, you have an opportunity to build wealth. It is easier to build wealth in direct investments, and especially storage.
If you look at
something you can control, and it has all these other factors that are wealth creation factors. Public markets are extremely regulated, right? They are open just to everybody. And they act as, let's take a CD or even a diversified stock portfolio, right? A CD at 5%, like you were mentioning, you get 5%. That's it, a year moving forward. Stocks go up and down. You don't have control over them, right? Average is a 7%, I think, annual return, historically speaking, 7 to 9, whatever that is, right? So you have CD, 5%, 7 to 9% in stocks. And that's your return. Now, yes, you may say, well, I'm an incredible stock picker. Well, great. That's, there's not hardly anybody in the world that is, except Nancy Pelosi. So unless you got that information,
there's an app that you could use.
There's an app that maybe you could use. But, outside that, the reason why people, even if you're a good stock picker, why that actually generally doesn't matter, because the stock and public markets are affected by movement of capital, not just performance. You can have a company that's doing good and its stock can still go down. So it's not like you can just go pick. There's more things at play here, and especially the large movement and economic cycles of capital flowing in and out. So you're going to get 7 to 9%. Only the top people really beat the market, right? And they are generally institutionals.
Well, how many times has Warren Buffett been like, yeah, cool, you do, like, you think you can beat the market? Great, I'm going to invest X into the S&P 500. You can go and do your thing.
Warren Buffett's just like, just put money in the S&P 500. Like, just do it, let it track. And so you're going to get that 79. Now, that is a straight return, okay? Now, if you go to a direct investment, it's not that simple. We mentioned, like, even comparing, let's say, take in between, you got a 5 and a 10%, right? Let's even take the low end and just say you're going to get a 5% cash flow, okay? Well, here's the thing. If you get 5% cash flow first year and you own a storage facility, that's not the only return you're getting. That 5% is leveraged, okay? So what that means is if you bought that facility for, and I'm using simple math here, so we don't need to, get complicated, but let's say it's $1 million. The net income on that $1 million was $50,000. That means that was a 5 cap, right? So that $50,000, you paid $1 million, you're getting $50,000 a year. But the gross income on it is whatever, $250,000, okay? So if you got a 5% cash flow, right, from this property, now stocks, let's use an example, go up 7%. That's how you got your return. In this scenario, if you matched and said the stocks went up 5%, well, what's 5% of $250,000? It's $12,000. All right. Now, $12,500 would be the increase on your amount. But that goes to net because your expenses are already paid. So $50,000, right? Net income is what you were making. If you take that and you say, we got 12,500, that is hold on here, everybody. I know I should never do math on the podcast. This is my fault.
Disclaimer.
Exactly. $50,000, especially when I'm making it up in my 25% increase, right? So roughly 25%. Then the leveraged effect on that changes the $1 million value. Is that roughly right, Connor, here? Because if it was 15,000, right, to 30,000 less, so it should be about 25%. Now, the cap rate takes that, because you put that $1 million is what it's valued at $50,000. But that's a 25% increase in net income, which then increases the total value based upon what it's bought at. So a 5% increase on your revenue from here versus a 5% increase, once again, in like the stock market or whatnot, it's going to leverage that return massively. All of a sudden you made, $150,000, $200,000 from that increase in cash flow. Now, also, you have debt payments, as in the renters are paying down your debt. So while it's increasing your cash flow, that bottom line number over years, rent goes up, that net income goes up. It's being leveraged because of the cap rate or how it's valued that we talk about. And then the other side is you're making those debt payments from renters. So we don't put a lot of debt on storage facilities. We put down like 45% right now. That's what we're doing. So we put a lot down on these assets. They are the number one least defaulting commercial real estate asset. The default rates are just crazy low. Because first of all, we put so much down and it's diversified. So you have two ways that you are creating value. Rents are going up. Your debt payment, the renters are paying the bill, right? So they're paying the debt. You're getting the net cash flow. Every time they're paying principal down. So the amount you owe is going down every single month while the value's going up because of cash flow. That spread is huge. So the wealth that you're creating, you may be getting the same return, meaning 5% or 6 or 7% or whatnot, that the stock market is going up, but you're not getting a 6% return in your wealth, which at the end of the day, that's all you're getting out of that stock portfolio. Because when it's going up, 6, 8, 9%, whatever that is, that's not cash flow coming to you. That's the value of the stocks.
I was going to say, the unrealized return versus the actual cash flow that you can achieve and get from a storage facility. Because unless you sell,
you don't get it.
You're not getting it.
Right. And so you're getting paid while it creates that wealth for you. And that ability to get your renters to pay down debt, your rents to go up, especially with inflation, right? That spread is massive over a few years, all while you're getting paid to own. Now, when you look at like a CD, that's just straight, you're getting paid. And when you look at inflation is killing those returns. Inflation helps you with real estate. Prices go up.
Exactly.
So they're also hedged against that. Now, when we talk about this, once again, I am comparing here direct investments more. Like I'm saying, if you went out to buy a duplex or something like that, right? Same effect here. The only difference is you can get higher increases. You have more diversified. It's a commercial real estate asset, so it's based upon net income. You can market, you can do all these things to affect it. When we look at public markets, the difference and the benefit in public markets is quite simple. It's liquid. It is generally way safer due to the fact of debt, right? Now, you could pay for a small storage facility and not have debt on it. That's great. Now, you will have maintenance costs, things like that, but also you're getting paid for that. The renters are paying for that. But you lose a lot of the benefit on commercial real estate if you have an asset that's default rate is like nothing and you don't put a lot of debt down on it. It's still very, very safe. The stock market is more liquid, but at the same time, you can't control those returns. So if you need it to be liquid, but then you need to take it out 6 months later and the stock market's down 15%, you just lost 15% of your money. So they're different. But when we're talking about people actually investing that direct investment route, you're using some of these principles, right? As opposed to a business, right? You get a mix with storage. The wealth creation process, higher rents, makes that net income go up disproportionately. A 5% income in gross revenue is a 25% income.
I was just going to say,
net. It's huge.
So I had a call again with another one of our coaching clients, a few days ago, and he was looking at this small facility, and it was like a minimal increase per month, where he's like, man, I can't really drive rates a ton, and just for easy sake, I ran some numbers, and again, caveat, ran some numbers on my phone. Disclaimer, throw that in there wherever. Just at $3,000 extra dollars a year in income on a 6 cap is $50,000 of value.
Yeah,
that's what we're talking about in this incremental revenue game that you can play with rates and how that drives value. Because then when you go to, again, you've got it leveraged, you go to, do your cash out refi, so you can take your money out, give it back to your investors or your partners, or going on to and buy the next one if it's just you, whatever. Like, you just cannot do that with these other more traditional options. Doesn't exist. It's
a wealth creation tool. Now, there are obviously risks and downsides. We mentioned the debt, but you have like markets that get overbuilt, different things like that, right? That can take time to recover, that now you're holding on to. Now, there's ways though that you can hedge and work against. We happen to be at the bottom of a cycle, not at the top of a cycle. So that's really good and takes a lot of that out. but we're not including all the benefits still. One of the main benefits you get is taxes.
Yes.
So we can do a cost segregation and accelerate depreciation year one. When, as one of our investors said, we put the money in, and they are a real estate professional, and we came and we bought this asset. The cost segregation was done. We accelerated the depreciation. It was something like 65, 70%. And he's like, I got a 65% return because I got that money back, right? That I would have paid in taxes.
Right.
So to him, that was a real return.
Do we want to break down what cost segregation is real quick?
Yeah, absolutely. That's a really good point. Cost segregation is when you have hard assets, we get depreciation because over time, those assets depreciate, right? Weather, things like that. So there's tax breaks to update them and keep them going, which is really good because if you've ever been in a country that doesn't have depreciation, let's just say it shows.
It doesn't work out well.
There's no reason to keep putting in if you don't get those benefits. But we can do a cost segregation, which looks at all the pieces because everything has a different depreciation schedule, meaning that the cement depreciates at a different lifespan than a light bulb does. So what cost segregations do is they look at all the buildings and all the pieces, the handles, everything else, and some of those items, they can accelerate the depreciation to year one. So you can take it all up front. And then other ones go over the lifespan. That allows us to take that depreciation in year one, like we were saying. So then all of a sudden, he gets a huge tax write-off year one. Now, for us and for others, that is massive.
Especially if you're going in and driving revenue hardcore, like having that first year of like you're driving revenue in a big way and then being able to offset that tax exposure to the massive increase in revenue. It's amazing.
I mean, when you talk about real return, that is a incredible driver.
Yep.
Taxes are the biggest expenditure you have. If you are out investing, this was something that I learned early on when, especially in sales, where after a certain income bracket, all of a sudden we're getting taxed 40%. We have nothing to offset it. And then I was trying to invest and I'm like, if I invest $1, I have to make almost double my money just to get back what I lost because I lost half of it basically in taxes. So I'm not investing $1.
Yeah.
I'm investing 50 cents because that's what was left. So in order to get back to just what was taken from taxes, I have to double my money.
Such a good point.
So when you're getting depreciation, you can write off, and it's the equivalent of getting like that 50 cents, which makes your compounding ability so much more powerful. This is what I think I didn't understand when we started, that the payment of debt down by your renters, the increases over time in your rent, and then your depreciation and the spread between those things was so massive. It was a wealth engine that 10 years later was far beyond what, frankly, we could have imagined. It really, really was. Now, it is a long-term investment, okay? The downsides are it is more hands-on, right? That is why you're direct investing. But it's also a wealth creation, not just I'm hoping that over the next 10 years, I get a 7% return, right, annually. So there is this wealth creation. But we can hire third-party management companies now, so you don't have to run it day to day. That doesn't mean it's a ATM. That doesn't mean that there's no work on it, right? This isn't some easy get rich quick, like, oh, I'm just going to do it. No. Even if you have a third-party management company, you need to follow up with the third-party management company. You need to make sure they're doing and executing the plan. You need to know what to do. You need to know how to value it, right? The difference is how I look at it. I'm like, 20% more effort on this side compared to no effort yields you such disproportionate returns. It's wild.
Yeah.
And so if I'm going to directly invest into duplexes or a home or whatnot, to me, all of a sudden, I'm like, why?
Yeah.
Why wouldn't I go down this road? I get these huge tax advantages. We get the leverage. You get the cash flow. You get to have a tangible hard asset. it offsets inflation. You have all these levers that you can pull to optimize. So I can actually find something that I can improve that value on and create a business plan. And when we say that, guys, we're talking very simple things. This is not complicated, right? Like our whole entire business model when we got started. Answer the phone, right? Make sure people pay.
Have a website.
And make sure people know you're there. Like that's what we're looking at.
It's so true. Yeah, no, all really good points. And I mean, we didn't even touch on the 1031 exchange aspect. I know this is similar in other real estate asset classes. You can still 1031 other real estate asset classes outside of storage, but obviously you can't do that with a stock market. You can't defer your tax exposure through 1031. If you go and sell a bunch of stock, like you can't, is there any kind of tool like that in selling stocks? Or
there are different tools that you can do with selling stocks that are kind of like 1031 exchange, and you can 1031 exchange all sorts of different assets, but it is not like real estate.
Yeah.
So when you look at real estate, the depreciation that you get, the offset, and the tools that we could do, it is one of the greatest tax vehicles that there is. And that's important, right? That keeps money in it. That keeps money going because, first of all, you're growing your money. It saves you on taxes.
Right.
But then you want to buy more. So the government set it up that way. They want people investing in real estate. The government wants you to provide services through real estate, whether that's housing or commercial real estate. That's important infrastructure that we need. So the incentives are really, really good associated with them.
Yeah, for sure. And for those of you hearing that for the first time, 1031 exchange, if you're going in, you sell an asset, you can reinvest those funds from the sale into a similar asset and not have to pay the capital gains tax.
Which is huge.
It's amazing. It's an incredible tool. Hopefully it stays around for the rest of forever. I know that's been a discussion even up recently of like trying to eliminate it, which is totally ridiculous.
Yeah.
So hopefully that sticks around. Before we wrap up, what I wanted to do is circle back around and touch on this, why storage is such a great first investment to really get people over that hump. When you first started, AJ, you talked about like you even had some of those like, oh my gosh, big scary commercial real estate thing. What were some of those fears? How did you overcome them?
So I think a lot of the fears, first of all, the fear of, to be frank, debt. That was like, I had such a negative connotation with debt.
There wasn't like a separation of like consumer versus
no, exactly. Like, there wasn't. And that was the one thing that, we really defined. So is investment debt and consumer debt are totally different. Consumer debt is like the worst thing ever. You have a depreciating whatever it is that you bought, and you have debt that you have to pay on it, and there's no value there, and it's monthly payments that are going away. Where investing debt is actually an asset because the renters pay it down. Now, it can be bad if you do it wrong. One of the nice things about environments like today, though, is there's a lot of protections built up. As in, people are looking, banks are looking, and it's like, no, we have to throw everyone mind. And self-storage, we put a lot down. That's just part of it. That's how it works. So hence the reason why, once again, it's low defaulting. But I didn't have this idea. It just, debt, the word was like, oh, it's scary. It's really, really bad. And the thing is, that is true in certain contexts. It is an asset in other contexts. There's our economy, the world's economy, not just economy. Like if money is debt, debt is money. There's no ifs, ands, or buts. It's either using you or you're using it. And if you have no debt, it's still using you. So that is how the system works. Like there is no not having it. The cash that you have is being destroyed by debt. That's why we have inflation, right? This is how the system works. It is not a flaw. It is a design. And that's why it's set up that way, so that you and other people use debt appropriately, but they actually use it and build things and put it into the system. That's why the largest markets are not, the stock market is not even close. It's the bond markets. It's the debt markets are the entire markets, trillions and trillions of dollars, right? It's how everything works, how you get food, everything else. So I had to really understand debt and change it. But that at first was just scary. just because of the word, right?
Makes sense.
The next thing that was scary, I think, was the not understanding. As in, we believe that familiarization equals lower risk. Oh, I understand a house because I live in a house. I bought a house, so I understand then buying a house and having a renter. There's simplicity in that because we participated. That doesn't translate, though, into that is less risk necessarily, or that's a better investment. All you do is you're like, I get it better. So that seems less risky, right?
Familiar versus, familiar versus like understanding almost.
Yes. So I needed to just understand better. But that's why we do what we do. That's why we're here. Because once you do, then it's like, oh, geez, why would I ever go the other way around, right? I would never use debt in that manner.
Yeah.
That all of a sudden is very scary to me. If I was to go buy a home and rent it out to people and I had to put debt on it, that debt is scary to me. I have one person in that home. That home can depreciate, and I didn't buy it on net income.
Yeah.
So
one roof away from failure.
Yeah. I'm like, oh man, that seems scary. Yeah. Whereas storage, it's like we got hundreds of doors, hundreds of renters coming in. They're paying down our debt. Their income's coming. I don't ever lose sleep at night, and I have $200+ million of debt that I personally guarantee. Don't lose sleep. I went through the great financial crisis, went through 2008, went through COVID. We went through. I've been through these things. We've not had issues, and that's something once again that is a tool that you can use and is regulated. So I think that was the number one thing, the familiarization, right? But the familiarization too, that I think one of the reasons why it obviously didn't stop me, that was something I could change. The concept alone of the CapEx is low. There's nothing in this building that is going to flood 3 floors and I'm going to have this huge issue. I don't have that kind of expense or exposure. These are metal boxes on cement. I have a gate, maybe an office. I have cameras, right? I get this. This is not, and I don't know anything about building. Like I am not a handyman. I'm not, right? But I would go out to the site and look at stuff. I feel there's nothing out there out of the realm. So it was easy enough. Understanding the actual management of it, yeah, there's a little learning curve like there is with everything. Those are probably the two biggest, just familiarization and debt that I think is scary. Outside that, it's just boring.
Yeah.
Like, I mean, like, honestly, these are metal boxes. These are garage doors. Yeah. No. Like, people are paying down your debt by putting stuff on a floor. And every month, they pay you. Every year, they pay more. And over the long run, you're making hundreds of thousands of dollars on that spread. And so it's just boring. And it just click, 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 click. Works.
Yeah.
Like, I mean, if you avoid the big ones, big dangers, right? Which is the biggest dangers that you've got to familiarize yourself is the biggest threat to storage is storage, as I've always said. That one. And 2, depending on risks you're taking. Like, I take lots of risks in storage now, right? I do value add CO deals that we're filling up because I want higher returns.
I was going to say the lease up ones.
The lease-up ones, those can be tricky, right? I do conversions, but you don't need to do anything like that. You can just buy a normal storage facility like I did starting out. Then as you familiarize yourself and are willing to accept more risk, then you can take that on as you grow. But I mean, just buy a storage facility that has renters. That's what we did to create a portfolio. We didn't even build a storage facility or take anything risk like that till 10 years after we started.
Yeah. Dude, that's such a good reminder too, because I think so many people feel like, oh man, like I'm behind. I need to get going now. I need to get this thing done or built or bought or whatever.
Yeah.
And on to the next one and the next one. And it's good to have those stretch goals, but I think it's also good to be based in reality at the same time and understand that it is going to take a long time.
It's going to take time.
It's a long game to figure out what your processes are going to be, how you're going to operate.
And that's not bad.
No, because you want to succeed.
And 2, wealth creation, I say this all the time. It's so funny because the greatest driver when it comes to creating wealth and, success. The biggest asset you have is time. Like time and money is magic.
Yeah.
And when you look at investing thesis, philosophy, everything, young people have the most time, and yet they have the least patience. I was that way.
Yeah.
Right?
Yeah,
I'm like,
sure.
That's not quick enough. And then old people have the least time, they have the most patience. If you were young and you could invest in real estate, you think 5 years is a long time. It's not at all.
So
5 years
fast.
is so fast. And so when you start to look at and that's a total turnaround of an asset. Like it's not that long, and it's okay to take time to get the right deal, because what you're doing is you're building a system. Don't think of it as just one deal. The first deal sets you up to buy the second deal, the third deal. And so what you're doing is you're getting good at that, and that magnifies those returns and everything moving forward. And so what you will do by getting a good deal and doing it right, having knowledge in that asset and familiarization with it, you will make up for in returns because you bought a good deal, whatever you lost in time.
Oh man, it makes me think of this comparison that you talk about, the book learning that you have, and then the real world, like on the ground, on the job training that you get in learning, hands-on. Because dude, yeah, you guys can listen to this podcast, you can read AJ's book, it's great. There's so much detail and so many things to help streamline that process, or like what Alex Hormozy likes to talk about, paying the ignorance debt.
Yep.
There's all this stuff to help you limit the amount of ignorance, tax that you're paying. Not debt, but the ignorant tax. But at the same time, you're not going to be able to, you can't beat time, and you will not be able to actually figure things out until you get in it and start doing it.
Yeah.
Period.
You got to get exposure.
Yeah.
Exposure. And I think that this is why I like to tell people, start small and then go big. The reason being is you're getting exposure. Find a good small deal and then move from there.
Dude, that's another phenomenal point to where it's like, oh, well, I'm looking at this deal. It's my first one and it's only a 5% return. It's like, well, is that 5% return worth being able to achieve that 20%, 5 years from now or 10 years from now?
And normally it's only a 5% return because they're not actually seeing the return. All they're doing is looking at a straight line, and they don't understand, oh, this expense can be cut out, or there's a 10% delinquency. If I just got rid of the 10% delinquency, that 5% return is now a 15% return.
Yeah.
So most of the time they see 5%, but that's with everything else that actually that asset's going to make you much more. But you just can't see it yet.
Yeah. Dude, I love it. This is a fantastic episode. I hope you guys really understand now the difference between traditional versus storage versus other real estate asset classes, and we can help guide you guys through those decisions. If you want to go and be, passive and throw your money in the S&P 500, whatever, totally your call. But if you want to invest in storage, you want to capitalize on all these things we talked about, make it happen. We got all the tools necessary. We've got our community. We've got all these resources for you to get out there and actually find deals, to underwrite them, to close, to operate them, all the bits and pieces, start to finish. And we're excited to help you guys out.
Thanks, everybody.
Thanks, guys. We'll catch you next time.